You're watching Chairman's Briefing, and I'm Rachel Lee. This episode is brought to you by Dryden Gold. Let's get started. The U.S. Federal Reserve decided to keep interest rates unchanged this week, despite pressure from President Donald Trump to lower borrowing costs. Fed Chair Jerome Powell used his post-decision press conference to assert independence from White House influence. He said that, quote, "It doesn't affect doing our job at all. We're always going to consider only the economic data, the outlook, the balance of risks, and that's it." So while Powell is insisting that political pressure will not sway monetary decisions, Trump's aggressive tariff policies have definitely created what Powell himself called so much uncertainty that officials cannot clearly determine their next move. This uncertainty has cemented the Fed's cautious stance, the wait-and-see approach. When pressed about potential rate cuts in 2025, Powell was unsurprisingly non-committal. There are cases in which it would be appropriate to cut rates this year, and there are cases in which it would not. For investors who are seeking some sense of clarity, Powell's message is that economic data alone will drive monetary policy decisions, not political calendars. The intense churn in the gold arena can be compared to New England's rapidly changing weather patterns. If you don't like the price now, wait a few minutes. Though the dips may rattle a bull's conviction, they're short-lived and the bounce back can be decisive. This is classic bull market behavior. Here's a 3-month chart tracking the spot market. Central banks have been continuing to accumulate gold despite record prices, which we can say signals profound distrust in traditional reserve currencies. China added gold for the 6th consecutive month while actively reducing its U.S. Treasury holdings. Year-to-date net purchases for China now total 15 tons, helping to lift gold reserves to just under 3,000 tons. Poland emerges as the most aggressive buyer, already acquiring 61 tons this year so far, which is 2/3 of its total net purchase in 2024 at 90 tons. The World Gold Council reports that central bank purchases remain 24% above the 5-year quarterly average, despite slowing from last year's record pace. Bank of America analysts have unleashed their most aggressive gold forecast yet, projecting that prices could soar to $4,000 per ounce in the second half of this year. This stunning prediction comes after their March forecast of $3,500 by 2027, which was shattered in less than a month. Michael Widmer leads the precious metals team at Bank of America, and he points to global trade tensions and growing concerns about U.S. fiscal stability as primary catalysts. The bank specifically notes that gold could prove less risky than Treasury bonds in this climate. But for the remarkable target to come to fruition, investment flows must increase by 18% year over year. While this figure could sound ambitious, analysts emphasize that such growth has occurred twice in the past decade. Near term, Bank of America sees gold comfortably supported above 3,000, although prices have recently stabilized around 3,200 after pulling back from record highs. The critical factor going forward is rising tariff policies, creating exactly the economic conditions that historically drive investors toward precious metals. Despite the S&P 500 recovering to within 8% of record highs, billionaire investor Paul Tudor Jones warns that the bottom is not yet in. Jones famously predicted and profited from the 1987 market crash. Jones told CNBC's Squawk Box this week that, for me, it's pretty clear. You have Trump, who is locked in on tariffs, and you have the Fed, who is locked in on not cutting rates. That's not good for the stock market. Jones believes that even if Trump reduces Chinese tariffs from 145% levels to 50%, the damage represents the largest tax increases since the 1960s, potentially slashing economic growth by 2 to 3%. Meanwhile, another well-known name, Ray Dalio, reinforces this warning, stating that businesses are already planning radically reduced interdependencies with the U.S. Jones predicts only that when markets hit new lows will the hard days start to follow. ultimately forcing both the Federal Reserve and administration to adjust their policies. Only then, he says, will investors get some kind of reality. Dryden Gold has confirmed drill results from their latest work at the Elora gold system in the Gold Rock camp. Tests have verified a new hanging wall discovery with gold concentrations of 301 grams per ton over a 3.9-meter section. This newly identified zone is characterized by folded quartz stringer veins in sheared basalts and sits about 80 meters from the company's main Jubilee zone. According to Dryden Gold, this hanging wall discovery suggests potential for additional parallel mineralized structures that are similar to findings from last year at their Big Master gold system. Dryden will be testing multiple regional targets on an ongoing basis, and shareholders can expect consistent news flow into the fall season. 3 junior explorers have reported new results from Colombia, a country that's gaining traction among resource speculators who are seeking early-stage opportunities along a landscape that's deemed highly prospective and underexplored. To evaluate these results as objectively as we can, consider industry benchmarks. Copper porphyry deposits typically become economic at grades between 0.3 to 0.6% copper equivalent, making collective mining's 290-meter intercept at 0.58 grams per ton gold plus 0.17% copper potentially significant if part of a larger system. For precious metals, underground mines often require grades that exceed 3 to 5 grams per ton gold to be economical. Soma Gold's channel samples are narrow, but substantially exceed this threshold at over 60 grams per ton gold in multiple locations. Next, Outcrop Silver's 18.3-meter intercept at about 992 grams per ton silver equivalent represents unusually thick, high-grade mineralization by industry standards. Of course, investors should always verify results through technical reports, confirm sampling methodologies, and compare with established deposits. All 3 companies trade publicly with full regulatory disclosure, allowing your verification through filings and qualified person statements. British Columbia is positioning itself as a critical alternative to U.S. mineral dependence amid escalating global trade tensions. And this is according to Mining Association CEO Michael Goering. Speaking at the Greater Vancouver Board of Trade, Goering revealed that the province hosts 16 of the 50 minerals that are deemed critical by the U.S., which remains 100% import dependent for 12 key resources. Quote, "We need to take urgent steps to enhance our economic security, our economic resiliency, and our long-term prosperity." He pointed to a newly identified pipeline of 27 mining projects that represents about $65 billion in potential economic activity. The province currently operates 18 mines producing aluminum, germanium, lead, and zinc, and more, with most exports heading to Asian markets rather than the U.S. But despite their potential, Goering acknowledged significant hurdles that include permitting backlogs affecting over 60 critical minerals projects that are worth about $27 billion. He called the current system too slow and too complex, warning that investment could flow elsewhere without streamlined approvals. And that's your briefing for this week. If you're not subscribed yet, please do so before you go. I'm Rachel Lee, and we'll see you next week.